Welcome to the session on U.S. Economic Overview. For Part 1, please welcome to the stage President and CEO of the Federal Reserve Bank of Minneapolis, Neel Kashkari, moderated by Federal Reserve and Economics reporter for the New York Times, Jeanna Smialek.
Neel, thank you so much. Nice to see you.
Nice to see you.
So you have an essay out this morning on the possibility that the neutral rate, so the dividing line between monetary policy that stokes the economy and monetary policy that slows it down, might have risen. And I wonder if you could kind of briefly summarize for us your takeaways, what your conclusions are here, and then we can go from there.
Sure. Well, we're facing a puzzling economic environment where the good news is we had rapid disinflation in the second half of last year, much faster than we had expected. So that's really good news, to around a 3% inflation level. And we had much stronger economic growth than we had anticipated. Those two things are a little bit puzzling. You would think if monetary policy is bringing inflation down, it would also be restraining economic growth, but we didn't see that. Now, in the first quarter of this year, conditions have changed a little bit. Inflation seems to have gone sideways, while economic growth has remained resilient. So it's led me to question, is monetary policy having as much downward pressure on demand as I would have otherwise expected? And one place I look at is I look at the housing market. The housing market has seen some evidence of slowdown. Mortgage rates have gone up a lot, but overall the housing market has also remained remarkably resilient, far more resilient than I would have guessed, having pushed mortgage rates, 30-year mortgage rates, up to around 7.5%. So when I look at this constellation of data, it makes me wonder, are there some dynamics of the reopening U.S. economy that has led the neutral interest rate to go up, at least in the short run, so that instead of putting 2 feet down on the brakes, perhaps monetary policy is only putting 1 foot down on the brakes, or maybe it's not putting very much downward pressure at all. And so I was raising questions and laying out some of the evidence that I'm looking at.
Obviously, as a policymaker, you have to come up with answers. I wonder what you think this means for the trajectory for interest rates. Is it possible we're going to have another rate hike? What do you think is warranted at this stage?
Yeah, I think right now, I would say a few different scenarios that I'll lay out. I think the most likely scenario is where we are right now, which is just we stay put for an extended period of time until we get clarity on, is disinflation in fact continuing, or has it in fact stalled out? I don't think we know the answer to that, so I would say the most likely scenario is we sit here for an extended period of time. If disinflation starts to come again and inflation starts to tick back down, or we saw some weakening, marked weakening in the labor market, then that might lead us to cut back on interest rates. Or if we got convinced eventually that inflation is embedded or entrenched now at 3% and that we need to go higher, we would do that if we needed to. I think that's not my most likely scenario, but I also can't rule it out.
Okay, interesting. And I guess what kind of signals are you looking for as you try and figure out if that third scenario is actually the case? What would make you concerned that inflation was embedded?
Well, one is, of course, just looking at the actual inflation data. I think one thing that's I think the committee is doing really well right now is we're all, I think, appropriately data dependent. We have different outlooks for where the economy may be going, but we're all very focused on what the actual inflation data is telling us. So first and foremost, what's happening to inflation? We have a dual mandate, of course, what's happening to the labor market. The jobs report on Friday was a little bit softer than expected, but not a soft not a soft job report. So continue to look at the labor side of the economy. One of the things I'm looking at is the housing market. I'm looking at new leases. We know there's a mathematical relationship between new lease rates and then over the course of the next year or two, those roll over into actual inflation data, housing inflation data. Curiously, the new lease rates seem to have ticked up in the last month or two. That's a little bit concerning to me. I wonder why that is. If we're putting so much downward pressure on real estate, why are new lease rates ticking up right now? That's also a place that I'm focused on.
Okay, interesting. And then on the flip side, what kind of evidence do you need to see to make you feel confident that inflation's actually under control and you can go ahead and cut rates? What is the bar there?
I think on the inflation side, we saw rapid disinflation in the second half of last year. Then, as I said, it went up in January and it kind of moved sideways in February and March. If we started to see some more inflation prints headed in the right direction, back down to our 3% target, we've had 3 bad inflation readings in a row. We shouldn't get faked out by one good inflation reading. I think for me, I would need to see multiple positive inflation readings suggesting that the disinflationary process is on track.
Multiple meaning 3 or?
It'll be the constellation of data. So it'll be more than 1, 2, 3 inflation prints, looking at the labor market, looking at housing as well.
Yeah, I got to try. I wonder, obviously as of the last summary of economic projections that you all released, the committee median was still expecting to make 3 interest rate cuts this year. Most Wall Street economists have sort of downplayed that at this stage. It seems unlikely that you'll have time. I wonder what your forecast is at this stage. Do you think those 3 cuts are possible? How many would you expect at this point?
I'll say in March, I jotted down 2 cuts for this year back in March. I'm not sure where I'm going to end up in June. There's still some more data to come in between now and then. It's possible I would stay at 2. It's possible I'd go to 1 or even 0. We need to look at the constellation of data. I know this is not a satisfactory answer, but it's the honest answer that it's very hard for me. I know it wouldn't be more than the 2 I jotted down in March. It'd either be that or less.
We've obviously got a presidential election in November. If you guys cut interest rates in September or just on the cusp of that election, it seems likely that you will be in the headlines right around the time of the vote. Is that something that would in any way sort of factor into your decision making? Like, is that a consideration as you think about what comes next with rates?
If we allow that to affect our decision making, then in a sense we're allowing politics to drive what we're doing. And we're all absolutely committed to not let that happen. And one of the things that, you all pay close attention, most of you, to what the Fed is saying. We are being incredibly transparent about the data that we're looking at. So when you see the data, you ought to be able to figure out, hey, this either means they're going to be a little more dovish or a little bit more hawkish. So I think the data is going to guide us, and I think the data is also going to give everybody comfort that, hey, we see why they're making the decisions that they're making. I can tell you it's not going to be based on politics or the election.
Yeah, interesting. I'm a reporter at the New York Times. I get a lot of reader email. And it's always interesting to see the trends that sort of evolve in my reader emails. And recently, a question I'm getting a lot from our readers is why, if inflation has come down below 3%, is the Fed so bent on getting it all the way to 2? Why do you need to hit that extra mile? Why not just say, this is fine, we've basically won. It was 9%, now it's 3%. This is a big improvement. And I always wonder how you would answer that question.
Sure. I mean, it is back to, and I know you're not going to be surprised by this, it is about our credibility of saying we committed to 2%, we met it, we can achieve that through our policy tools, and we are going to achieve it. And the thing is, if we stop short and we say 3% is good enough, then that undermines our credibility, and the next time that there's any type of an inflation spike, maybe you all and the markets and the public will think, well, maybe they're going to stop short again, and maybe it'll be 3.5, or maybe it'll be 4. And so we said 2%, we are committed to hitting 2%, we will hit 2%, and that's the best thing that we can do for the long-term competitiveness of the US economy.
I want to circle back to your inflation forecast, because you kind of laid out a couple of different scenarios, but you didn't tell us exactly what your most base case inflation forecast is at this stage. What are you expecting is most likely at this point?
Right now, it looks like the economy's in a very good place. Economic momentum is maintaining. There's a lot of resilience. It seems like things are kind of at steady state. So if I had to pick a scenario today, it seems like we're going to kind of go sideways for a while. And under that scenario, that would lead me as a policymaker to say we ought to just sit with interest rates for longer than expected and allow them to bite. One of the things that we hear is that maybe because so many Americans refinanced their mortgages when mortgage rates dropped during the pandemic, that there's a factor that monetary policy is not passing through to housing as quickly as it otherwise would because people are not feeling the bite of higher mortgage rates yet. If that's true, and I think there's some truth to that, then it may take longer for monetary policy to be fully felt by the housing market and by the economy more broadly. So that may guide us towards being more patient and seeing the effects of our policy actions.
That's interesting, because if we're in some sort of steady state, and if it's the case that the transmission to the real economy is just a lot less, potent than it used to be, mortgage terms are 30 years. That seems like potentially a really long. Like, what changes just by leaving rates high or at this level for an extended period of time that makes you confident that would actually be enough to get inflation down?
Well, I think the last part is, that would be where I'm not sure how confident I would be at that point. But we would have to try. I mean, I think the bar for us raising is quite high, but it's not infinite. I mean, there's a limit when we'd say, okay, we need to do more. I think much more likely we would just sit here for longer than we expect or the public expects right now until we see what effect our monetary policy is having. If you look back at the Volcker era of raising interest rates quite dramatically, very quickly, it took a few years for mortgage rates to really start bending up in terms of the average rates that homeowners were paying on their mortgages. So even in the Volcker era, it took some time for the pass-through to be felt to the housing market. So I would want to look at what are people actually paying. I mean, we do know, for example, credit card rates, if you have a balance, those are variable. So you're seeing some delinquencies rise in credit cards for subprime borrowers. You're seeing delinquencies rise in autos, also generally for subprime borrowers. So it's not as though monetary policy is not having an effect on the economy. It is. It's just not having as much an effect as quickly as I would have guessed.
Yeah, that's interesting. Do you think that weighing on sort of the very interest rate sensitive portion of the economy, which tends to be sort of the lower half of the income scale, the people who use credit card debt, the people who use auto debt, is that enough to get inflation down, or do you have to have a broader effect than that?
Ultimately, we believe, and I believe, monetary policy essentially affects the whole economy. Some sectors more quickly, some sectors longer. We can do what we need to do to get inflation down using monetary policy. I'm confident of that. The art is we want to do that while preserving a strong labor market. So far, we've made a lot of progress. We've had some help from the supply side, but we need to finish the job.
I actually wanted to ask about the supply side, because one thing that some economists will raise is monetary policy obviously affects demand. In this cycle, it's kind of a weird cycle. We are very housing supply constrained, and obviously monetary policy also affects housing supply. We've seen less building. It's ticked back up recently, but in general, in multifamily and single family, home construction's way down, which means less supply in the future. And one of the arguments is this could lead to higher rents and higher inflation down the road. And I wonder how you think about that argument. Is it a concern? Are the side effects of monetary policy something you need to worry about at this point?
I think it's a timing issue. I think monetary policy and the monetary policy cycle that we're focused on is really the next 2 or 3 years to get the soft landing, get to our goals. I mean, it'll be hopefully be faster than that, but it's over an arc of 2 or 3 years. The supply side effects that you're referencing, I think, are much longer term effects. I mean, I think I'm in no way suggesting this, but if we had a high interest rate environment for an extended period of time, then that would have an effect. You would have capital being allocated to other sectors of the economy rather than to housing, and so that would lead to less housing supply. But I don't think that that's the same thing as the monetary policy timing and cycle that we're operating under.
Okay, interesting. When it comes to financial conditions, they are obviously a lot tighter than they were at the start of the hiking cycle, but they are considerably looser than they were last fall. And I wonder if that is something that worries you. Is it something you think is appropriate? How do you think about where financial conditions sit today?
No, it's a good question. One of the transmission mechanisms for monetary policy is, of course, through financial markets. And financial markets are so wired for exuberance. I look at this. You had 3 negative inflation prints in a row, and markets started to take that on board and get a little bit concerned. And then you had one somewhat positive jobs report, and then there's back to the races again. Exuberance has returned. I mean, it's like that's a pretty strong disposition to exuberance in financial markets. So that does give me concern. And again, what are the financial markets telling us about the stance of monetary policy? If the financial markets are this exuberant, are they behaving in a manner consistent with monetary policy that is tamping down demand in the economy? That's a little bit of a head scratcher. And looking at financial markets is also a challenge for us, because financial markets are obviously paying attention to what we say and what we do. So in the essay that you referenced, I speculated that could it be that we and markets are misperceiving the neutral rate? That we and markets think the neutral rate is lower, and that's what's resulting in this inverted yield curve, but actually the neutral rate may be higher. well, could the financial markets be paying attention to what we're saying about the neutral rate, and then we're influencing the market's judgment? And so, for example, there's this thing called the Blue Chip Survey of Financial Forecasters, one of many indicators that we look at. I'm always skeptical of the Blue Chip Survey because it's basically a bunch of former Fed economists who are out working on Wall Street. And so we're basically talking to ourselves. And it's like, great, we look in the mirror and we like what we see. I mean, that shouldn't be that comforting. And so where are the independent pieces of data that can give us some guidance? And it's complicated.
I wonder, going back to the rates trajectory, Chair Powell last week during his press conference after your FOMC meeting mentioned that one scenario in which you all could cut rates is if the labor market starts to just go to pieces unexpectedly. And it sounded as though that was sort of independent of what happened with inflation. He didn't specify, but he didn't, have an inflation trajectory during that scenario. I wonder, A, do you think that's true? If inflation stays stable but the labor market falls apart, would that be a reasonable reason to cut? And B, how much of a sort of falling apart in the labor market would you need to see? Like, what would the standard be there?
It's a good question, and I don't have a good answer for you. This, we've talked about at the FOMC that we, of course, have our dual mandate, stable prices and maximum employment, and that if these two goals were in tension, that we would take a balanced approach. Now, we have not exactly defined what that means. I think each of the 19 participants would have their own interpretation of what balanced means. Let me give you a very simple example for the sake of math. I'm not advocating this view, but it'll be clear. So we have a 2% inflation target. If inflation right now is running at about 3%, so we're missing our inflation target by 50%. If we think the maximum rate of unemployment in steady state is around 4%, a 50% miss would be 6%. So one model could be 3% inflation and 6% unemployment. Those two things are now equally missing. I'm not saying that's the right comparison. But we have not articulated to each other exactly how we would trade off. And I think that would really come down to the judgment of the various policymakers around the table. Again, looking at the constellation of data.
Yeah, absolutely. Up to this point in this conversation, we've mostly focused on sort of the median outlook, what's the most likely outcome. I wonder, what do you see as the tail risks right now? It seems like there's a lot of uncertainty out in the world with commercial real estate, with geopolitics. Like, what is keeping you up at night?
A lot of things. One, first and foremost, is underlying inflation. Is underlying inflation actually, are we landing softly at 3% inflation? Okay, that's not good enough. That keeps me up at night. The other risk, by the way, is there all this pent-up impact of monetary policy that has yet to be felt by the economy, and this is going to hit, and would it hit quickly? That also keeps me up at night. Those are in conflict with each other, those two. And then it's these, the signals that we're getting. Are we misreading something in the economy? For example, productivity. U.S. productivity growth looks quite strong right now. That's great. Why is it so strong? Productivity tends to be a residual of all of the other economic calculations that are made. A lot of times the residuals can be wrong. They can be revised. Is that going to be maintained? I mean, there are big fundamental questions in the economy right now, setting aside all the geopolitical risks that you just mentioned as well. So there's a lot of uncertainty that we're trying to navigate.
If the accumulated rate hikes are just sort of like hanging in the wings, waiting to clobber the economy, what is the mechanism by which that would happen?
Yeah, boy, that's a great one. I mean, I'm not seeing it. I talk to a lot of businesses, large and small, and I actually asked this question of some big businesses, and most businesses that I talk to feel quite confident. They don't have as much pricing power as they had a year or two ago, but underlying demand seems strong, and it's easier to find workers, but they're still having to compete to find workers. So I'm not seeing the evidence of that, but I also know, I can't rule it out. Or it could be some shock. It could be that, one of the things I learned in 2008, having been running the TARP during the financial crisis, a lot of the risks, you don't exactly know where they are. So there's a lot of attention on commercial real estate risks. My guess is we don't actually appreciate where all the risks are buried. And my guess is that there are a lot of financial market participants who don't even realize they have some of these risks. And it's not just going to be US firms, it's going to be global firms as well. So there may be some surprises to come there when some of those risks materialize. And could that be a spark that catalyzes some broader response? I'm not sure.
I think with that, we are about out of time. Neel Kashkari, thank you so much for an interesting conversation.
Thank you, Jeanna. Thanks for having me.